want to make a brief comment on the auto and parts sector note Scott Murdoch and I put out earlier this week, which featured domestic sales data, global industry commentary, and broad downgrades across most of our sector coverage. So looking at the slide on the screen here, Australian industry car deliveries. So new car sales deliveries were down on the PCP by 5% year to date, but had improved in the previous half by 11.5%. Annualized sales are tracking at 1.08 million units, which is slightly up on calendar year 2021. So a solid result, still running slightly below the pre-COVID levels, but well below the recent demand that we've been seeing in the industry due to these supply chain challenges. So on the next slide here, I've got some so Scott and I closely monitor a lot of the global OEM and dealer commentary coming sort of across the globe. It's a useful lead indicator for our domestic market. I've included a few notable ones on the slide here. Broadly speaking, dealers in Australia and the US exited the first quarter with continued demand and strong order books, and we expect that trend to have continued through the second quarter. However, some of the recent commentary coming out from the US dealers specifically has emerged to pointing to a softening consumer demand, which is not surprising given the current macro backdrop of high inflationary pressures and rising interest rates. Production continues to be constrained, driven by the well-known chip shortages and supply chain disruptions rising mostly out of China COVID lockdowns, as well as the war in Ukraine. However, this is still expected to improve over the second half. And as you can see on the screen, the quote from VW CEO sort of shares that sentiment. On the next slide here, just looking at stocks under coverage heading into reporting season. The outlook for the supply and demand will be the key theme for this reporting season, specifically around current consumer demand. We expect commentary will point to demand profile being strong at the moment. However, obviously cautious in their outlook given the current rate environment and cost of living impacts, which will all clearly come through at some point. Given that, in the note we published, we took broad downgrades across Eagers, Warren, Motos, and Bapcor. On the next slide here, looking at the stock level across our listed auto retailers, Eagers, Warren, and Motos, our earnings, along with consensus, are falling with the cycle in future years. The dynamic of falling earnings is seeing the cautious sentiment to the sector continuing, and the D-rate that we have seen over the past year likely to sustained. Whilst the market will continue to hold caution on the sector, we do consider there to be value at current valuations, specifically on a long-term view. Eagers is the most diversified and well-positioned business of the three, and most well-positioned to withstand these challenges, and specifically the industry disruption over the next 3 to 5 years. Looking at Bapcor, the 4% downgrade is driven primarily by lowering our assumptions within the retail division, which we are fairly cautious on heading into FY23. BAP does remain a defensive business. However, we do see some risk around the retail commentary at the FY23 result. And for more risk-adverse investors, it would probably make sense to wait for the result, look for improved confidence before taking a more positive stance in terms of going forward. And very quickly, just touching lastly on Motos, it is a micro cap, it is a liquid, which means some more investor patience is going to be required. But we do remain positive in terms of the clean balance sheet position, the aggressive industry consolidation, of which Motos appears to have the market to themselves. And we consider this will prove the business's defensiveness and resilience and growth on a medium-term view. Trading on 6 times PE and a 10% yield, Motos represents good value. That's all I have. Been happy to take any questions.